Wow, look at this. Alibaba has dropped more than 20% in a couple of days. Last week the stock was trading at 260, now is about 215. What's going on? Is there an opportunity here for me to make a play? Let's find out. Welcome back, mindful investors. In this video, I'm going to talk about the different bullish strategies when you're making a bounce back play like this. There are three main option strategies. There are pros and cons for each of them, but ultimately I chose to implement just two of them. While we need a little context on Alibaba, if we look at the stock price this year, it's peaked at 317 on October 27th. So why did it peak at the end of October? It's because of the Ant Financial IPO. That was set to be listed a week away. But then China stepped in and said, no, I'm pulling the plug on you just 2 days before listing. Then that was the first crash from 317 down to about 258. And then it recovered and walked sideways a little bit until the second probe, the second antitrust probe. What happened was that the China government just came in and said, you can't monopolize the e-commerce space. We're gonna set some regulations so the playing field is kind of even. So ultimately, the China government took two stabs at them. The first one was the financial side, the second one is the e-commerce side. Both of these sectors would account for more than 50% of Alibaba's revenue. So that's why there's a second hit. First hit was 317 down to 250, that's like 20%. It bounced back a little bit to 260 and then it dropped another 20% down to 210, 220 range. At that point, there was a ton of fear within this company. And you know my number one rule, sell on fear and sell on greed. This is selling on fear. It's selling on fear that the government will come out and take Alibaba apart, take its monopoly and break it down to like 20 different pieces. That was the ultimate fear. But if we take a moment, step back, and just kind of look at it in a broader view, we see that in China, there are two big conglomerate companies, Alibaba and Tencent. So if they're taking Alibaba down, are they going to move on to Tencent next? Like, what's the likelihood of doing that? If they actually took Alibaba down, then these other companies will have no drive to grow. Because the way a business works, the more money you make, the more you want to make. There's a little cycle going on there. So in the view of these other companies, if their end goal is just being ripped apart by the China government, then what's the point of even growing? Alright, let's get back to the important things at hand, the different option strategies we can implement. If we're bullish on the stock, then we can do three different things. Again, we're going to display this in a little line graph here. That's showing is risk versus reward. And the one with the most upside is the long call. It's a home run play. And that depends on which contract you buy. If you're the ultra bull, ultra aggressive, you want to go for the 10x, I'll give you a 10x. I'll show you which one got the 10x. Alright, this is the option that expires December 31st. And that's tomorrow. We're going to see that the stock will jump 10% from the lows at 212 to 230 maybe. So 230 calls. We're going to look at its details. And we see right here on the day like just 2 days ago, at end of the day, these contracts were worth like $1.20. And today at market open, these were worth like an upwards of like $13 right here. So that was your 10x if you're willing to gamble it all. But if we look a little bit closer, I don't think anyone can time the absolute bottom and the absolute top. This top of $13 probably only lasted like a minute or maybe like just a couple contracts. But this down here, you could have bought it the whole day, but not at the very bottom, I don't think. Maybe at this 250 range. And right now, this contract is worth $8.75. We don't anticipate we can buy at the bottom and sell at the top. If any one of you can do this, let me know. I'll make the trade and I'll give you a huge kickback. I'll give you 25% kickback if you can do this consistently. Okay, now we look at the second play, the short put. What this play is that you don't think the situation is that bad. You don't think the China government will absolutely rip Alibaba apart. And you're setting a floor price on the stock. So as Alibaba dropped from 260 down to 210, you're saying that it won't go below like 180 or maybe 200 if you're more aggressive. So you're setting this floor that it'll hit 200 or it may never hit 200 and it'll bounce right back. That's what you're saying. I implement this strategy all the time and that's what I've done here as well. As you can see here, 9988 is the Hong Kong stock code for Alibaba because they're also listed in the Hong Kong Stock Exchange. All of these were negative contracts. That says I'm willing to buy these stocks at 170, 190, and 200 at different dates. As we look at the details, the stock in Hong Kong went down to 210 and then it bounced right back up to 236. So that's why these positions are mostly in the green, because it kind of found a bottom and then it shot back up. Therefore it found a local bottom. Now we'll look at the third play, the bull spread, bull put spread. It's identical to the short put, but I don't want to buy any shares, so I'm limiting my risk that way. I made this play for the Alibaba stock right here. I bought 10 contracts of this bull spread. If we go down a little bit, it says there are two different legs. One of the legs are selling a 185 put. The other legs is buying a 175 put. So ultimately for every contract, the maximum I can lose is $1,000. By buying 10 bull spreads, I was risking 10K. And my upside right here, if we go inside, we see the maximum upside here is 674, and right now is 559 in the money. So it's more than 80% up in 2 days. After seeing these three bullish strategies, which one would you use? For me in this case, I use these two, but many times I use the long call as well, but not in the very short term, unless I really feel like gambling. And why do I see it as a gamble? Because the likelihood of winning long calls, especially in the very long term, I say for this case, maybe 1% or even less. That Alibaba stock will have this V bounce for 10% in the last 2 days. How likely is that? Very unlikely. And what about these two plays here? What's the winning percentage of that? In my mind, is more than 95%. We'll demonstrate all these percentages with the concept of EV. By EV, I don't mean electric vehicles, I mean the expected value. The expected value of winning. This is a mathematical concept that kind of tells you when to bet or not. If it makes sense to bet or not. Let's demonstrate it with a toonie here. Yes, it's called a toonie. It's a $2 coin here in Canada. Okay, so whenever you flip a coin like this, you get two outcomes, right? Every single time, there are two different outcomes. Heads or tails. Every single time, no matter what you do. But what's the probability here? 50-50, right? So probability of heads equals 50%. Probability of tails equals 50%. Easy. Now let's look at this in a different perspective. The risk versus reward. Let's say if you were to gamble with me. This is a $2 game. What reward will it take for you to play this game with me? So ultimately your risk is $2. What outcome, what reward would it take for this bet to make sense? Let's say if I ran this game at a casino, the heads or tails game, and I want a 10% edge. So every time you bet $2, the reward is $3.80. Because I've taken 10% edge for the casino. If that was the risk and reward, $2 for $3.80, does it make sense to play this game with me? Well, we need to go back and look at the probability of each. The probability of heads and tails is equal at 50-50. So in order for this game to make sense for you, the reward needs to be at $4. 1-to-1 ratio, 50-50%, right? Now we'll go back to the Alibaba case, where we showed the long call that will get you the 10x. So the probability of getting the 10x is, in my mind, less than 1%. Less than 1%. But the reward here is 10x at its absolute prime. When you bought at the absolute bottom and sold at the ultimate high. The perfect timing for both these executions. That's when you got the 10x. Looking at this risk and reward, it wouldn't make sense at all. Because the probability of winning is less than 1%, that means you need to make this bet 100 times to win once. But the time you win, you only get 10x. In a simple case here, if we're betting 100 times and you won once, and the reward is 10x, then imagine every single game you're putting $1 in. So all your bet is $100. But you're winning for the final game, $1 to $10 will get you $10 reward. So you're risking $100 to win $10. Over the long run is a losing game. But let's say if you're very lucky and you hit the jackpot within the first 5 times. Let's say you hit the jackpot the very first time. $1 to $10 and you got out of the game. Then you're up. You feel invincible of the 10x gain in 2 days. But then a week later, you enter the game again. You enter the casino again and make the same bet. What's the likelihood for you to hit it again? Now we'll look at the probability of the short put and the bull spread plays. In my mind, the probability of this short put play is greater than 95%. Especially when my strike price is more than 10% away. And as we can see here, I'm risking 10k to win 674. 10k to win 674. That's a 6.74%, which has better odds than this 95% right here. So in the long run, it's a winning play for me. Even if it goes the other way, I can always roll my options. So that was my Alibaba bounce back play. What do you think? Drop a like and subscribe if you found any value in the video. Thanks again for watching. Take care, and I'll see you in the next one.